Folks, rate cut mania is back. The Fed is poised to cut interest rates in September. The betting markets are saying there's a 94% chance of a rate cut, and we could see 3 rate cuts by the end of the year. And in the next 12 months, we could even be seeing 6 rate cuts in the next 12 months. This is now causing a lot of people to go into a pandemonium in the housing market. The realtors, the investors, the mortgage brokers, they're getting whipped up into a frenzy, thinking that these rate cuts are going to reinvigorate the housing market, that the buyers are going to come back, and that the prices are going to go back up. However, I have some bad news for you if that's what you think, and it's the fact that it's unlikely we're going to see these rate cuts do anything really for the housing market, because we went through this already last year, everyone. Last year, the Fed cut interest rates by 100 basis points, and what happened in 2025? Home buyer demand dropped even further. I think we could see something similar play out over the next 12 months. However, I'm going to give you my exact forecasts on where the market is heading in terms of prices, sales, and mortgage rates later in this video. But first, we need to talk about the deflation that's now occurring across the U.S. housing market. That's right, everyone. Home values are now going down year over year in 12 different states. 12 different states across the U.S. are officially in negative territory. They're heading into a correction in 12 states. And on a month-over-month basis, according to data from Zillow, home values are now down in over 25 states. So we have roughly half the U.S. right now with declining home values. And that's a signal, right, of where the housing market is heading into the future. The inventory has piled up. There's now over 1 million listings on the market, according to Realtor.com. The builders have almost 10 months of supply on their lots. These are all things that happened back in the mid-2000s before the last crash. Well, they're happening again, because the real problem in the housing market right now, and why home buyer demand is at 30-year lows, is the fact that home prices are too high. It's the prices that are way above their 130-year average. It's the fact that people go on Zillow in neighborhoods like this, where I'm standing right now in Nashville. They see houses on the market for $800,000, $900,000, $1 million. These houses were selling for $500,000 only 5 years ago. And it's these sky-high prices that are scaring the buyers off. And I think basically what I think about this housing market, everyone, and it's important that you pay attention to this, is this isn't your parents' housing market anymore. I think a lot of people who are traditionalists in the real estate industry, they just repeat the same narratives that everyone repeated in the 80s and 90s and 2000s and 10s. They're like, yeah, lower mortgage rates is going to bring the buyers back. Everyone wants to buy a house. There's all this pent-up demand. I hear a lot of people saying there's pent-up demand to buy, right? Because those were all the old school narratives, the old school conventions. But folks, we are in a new reality in the housing market that you need to pay attention to. This new reality means we could just be seeing low buyer demand for a really long time. I mean, people aren't interested in buying houses at these prices. You know, I poll you guys on this channel all the time, and I ask you the question, why aren't you buying? Over 70% of you say prices are too high. I then look at what's going on with like Gen Z and millennials, everyone. And you know, the Gen Z and millennials, I'm a millennial, and then you have the Gen Zs. They're telling you kind of like where the housing market's going in the future in terms of interest, and it doesn't seem like anyone's really interested in buying a house. I talk to people my age, I talk to people younger than me. It seems like people are now like into like buying crypto. People are into, you know, buying and selling crypto. People are into day trading. People are into all these other alternative investments. And they don't view real estate as a good deal anymore, because it's not a good deal. The prices went up so much that you're not going to really get a good return if you buy a house. And I think home buyers intuitively know this. Home buyers intuitively know this when they go on Zillow and they look at these houses. You know, these are some nice houses here actually in this neighborhood of Nashville. I'm actually in a neighborhood of Nashville called Hillsborough. It's actually between Hillsborough and the West End. And these are cute houses. You know, this was a community maybe that was built back in the 50s, 40s, 50s, 60s. Some of these houses would go for $400,000, $500,000, maybe even less than that before the pandemic. Now the land value alone is $1 million here in Nashville and some of these desirable communities. And if the land value is $1 million, that means they're building a house that's going to sell for $3 million. And it's like, who's going to buy that? How many people are out there that can afford to buy a $3 million house? But I saw an interesting article recently, actually, from Zillow, everyone. This was an article talking to Zillow's chief economist. And Zillow's chief economist is saying that it could be a good idea for you guys to go buy a house right now. This was just an article that ran. It was either in the Wall Street Journal or Bloomberg. I can't remember which one, but it's here on the screen. And they're basically saying at Zillow that, hey, it's turning into a buyer's market. There's more inventory. There's more price cuts. The DOM is higher and sellers are more willing to negotiate. And, Zillow's saying, we don't know how long this is going to last for. They say that the growth in new listings has slowed and that, it's going to be a better time to buy in the next 6 months, but they don't know if a year from now or 18 months from now it's still going to be a good time to buy. So the argument goes, if you're looking at buying a house, maybe you should buy now, according to Zillow's chief economist. And I have a lot of respect, actually, for Zillow. They put a lot of great data out on the housing market. A lot of the data in Reventure app is sourced from Zillow. And, the people on their economics team, by and large, I think they know what they're talking about. However, I'm just going to, again, point out the flaw in the thinking, right, of saying like, oh, mortgage rates have come down a little bit, inventory is up, so you should buy. Folks, look at this graph. It's a 130-year graph of real home prices in America. And what I mean by real home prices, inflation adjusted home prices. So we're adjusting for inflation. And you can see the prices today are actually 80% above their long-term 130-year average, and they're the highest level of all time, and they're even more expensive than the '06 bubble. So when you tell someone that maybe you should buy a house today, like you should buy today, because maybe this is the best we'll get, I would just say you got to show them that graph before saying it. Because when you look at this graph, it's extremely evident that anyone buying in today's market, unless they get an amazing deal, is overpaying for the house compared to the historical norm. And there's also another question we need to consider, everyone, and that's that the Fed could cut rates, but mortgage rates might not go down. This is something that really kind of happened last year. The Fed cut rates last year in September, and then mortgage rates went up. Because mortgage rates are a function of the long-term bond market and 10-year treasury yields. They're not a function of the short-term interest rate the Fed sets. Very important you guys understand that if you're a prospective home buyer or just anyone wanting to increase your education and finance. It's not a given that the Fed cutting interest rates on the short end, which is what they control, is going to have an impact on the long end of the rate curve. So we could once again see Fed rate cuts later this year and mortgage rates that don't go down or mortgage rates that go up. Now, I think it's realistic to expect maybe rates to drop by a little bit. However, I wouldn't expect anything crazy. Maybe mortgage rates go from 6.6% to 6.3%, 6.6% to 6.2%. I think there could be a little bit of relief in the market, but the only way we're going to get massive mortgage rate relief is through a recession. That's right, everyone. The easiest way to drive down borrowing costs is to have a recession. And this economy, the last 3 to 4 years, has continually dodged a recession. Me and a lot of other people thought there'd be a recession in 2022 when the Fed increased interest rates. There wasn't. Other people thought there'd be a recession in 2023 during the banking crisis when the banks failed. There wasn't. People thought there'd be a recession after Trump increased tariffs. There wasn't. So this economy on a macro level has almost been amazing in its resilience, right? Like the macro economy is holding on for dear life. Like it's like holding on the ledge, right? Clutching its hands, and it doesn't want to go into recession. But the headwinds keep on mounting, right? The headwinds keep on mounting. We have all this debt in the government. We have all this student debt. We have all this mortgage debt. We have all this credit card debt. The credit card default rate now is at similar levels to the mid to late 2000s. Again, folks, some of these new build houses here in Nashville, where I am right now, and I'm going to tell you my zip code here in a second, so you could look it up on Reventure. Some of these new build houses are selling for $1 to $2 million. And folks, like $1 to $2 million, that's a mortgage payment anywhere from like $8,000 to $15,000 a month. Like, who is paying that? Who is paying that? I mean, look, folks, this is a nice looking new build house. Don't get me wrong. Would love to buy this house, but not for the price point it's listed at. You have some houses here. This one says sold. This is a new build. These are two new builds right next to each other. This one's sold. This one's still for sale. I believe this is a hair under $1 million. This was originally 1.15. They now cut it to a little bit below $1 million. Are they actually attached? They're attached. So you'd be spending $1 million to be attached to your neighbor. There's something insane about that, just from a fundamental perspective. And sure enough, the home sale activity in this zip code has plummeted. The prices have just become too high, so the buyers aren't really there anymore. So I'm in the zip code 37212 in Nashville. So get out your ReVenture mobile apps, and at the end of this video, download the ReVenture mobile app if you haven't already. I know a lot of you watch me on TV. Over half of you watch me on your TV. So if you're actually watching on your TV right now, you download the ReVenture mobile app right now so you could track where I am. 37212. So I'm just to the south of downtown Nashville. This is a neighborhood called Hillsborough / the West End. We're kind of on the border of Hillsborough and the West End. Vanderbilt University is literally just over there. So we're right next to Vanderbilt. The typical value of a house in this zip code, everyone, $786,000. Whew. Just a standard house. Then you got the new builds for $1 million. $786,000. Now the values are about flat year over year, but I think they're going to go down. ReVenture's data suggests they're going to go down because we have now, look at this everyone, if you go to for sale inventory on the mobile app, 135 homes for sale through, this was July 2025. The normal number of homes for sale in July is 70. So our inventory is almost double the long-term average in this zip code, and that's mainly resale inventory as well. Additionally, the days on market has gone from an average of 40 days on market in July to 79 days on market currently. And that's data from Realtor.com, which you can find on the ReVenture mobile app. And I'm going to reveal actually my forecast for this zip code in a second, as well as some other cities in the US. But I just want you all to understand that data. When you see for sale inventory through the roof like that, and you see days on market through the roof like that, that is telling you you're in a declining market. So even if the values are flat year over year, you have a strong suspicion that they're going to drop in the future, given how long the houses are sitting, how many homes are for sale. And by the way, what about demand? Well, the demand, folks, the home sales are down 50% from peak. So 4 years ago, in June or July, they did around 41 home sales in this zip code. Now they're doing 19 home sales in a given month. So the months of supply here is through the roof. That's data from Redfin on home sales that we source on ReVenture app. And so all this data, folks, is at your fingertips if you download the ReVenture mobile app and you upgrade to a premium subscription. I'm going to talk more at the end of this video on how you can do that. But if you're a home buyer and investor trying to make a decision, you've got to access this data, because there's no way that you should be buying a house for hundreds of thousands or maybe even millions of dollars without knowing where the market is heading in the future. We think this zip code is going to have a 9.4% decline over the next 12 months. That's what the data on ReVenture app is telling us. It suggests that if you were to buy in a zip code like this, you would want to negotiate with the seller. You would want to go to the seller and say, hey, I love your house. Your house is amazing. I'm a bit concerned about the market. I have some data that suggests the market could go down 9% in the next year. Here's my offer based on that data. We're actually finding that a lot of our users on ReVenture app are having success with that. We're getting users giving us some feedback saying that they're saving anywhere from $50,000 to $80,000 on buying houses below asking price by using our forecast, particularly in markets where our forecast is negative. So you're going to want to go on the ReVenture mobile app and see what that 12-month forecast is in your area so you can make a more informed offer and potentially get a house below market so you can buy and anticipate where the prices are going and get a good deal. But I just want to talk a bit more, everyone, about why I think that the rate cuts coming at the end of this year, and these rate cuts are definitely coming, everyone. I mean, the prediction markets are saying 95% chances of one cut in September. They're saying by the end of the year, there's going to be 3 cuts, meaning the short-term interest rates are going to be around 3.75% by the end of the year. So these rate cuts are coming. But what is it going to do to buyer demand? Are the buyers going to be motivated by that? And is it going to even filter through to mortgage rates? And I think one statistic that has me thinking that the buyers are not going to come back and is informing my perspective is the difference between buying and renting, the cost differential between buying and renting. Should you buy or rent? This is the classic age-old question. Should you buy or rent, especially for first-time home buyers? I know a lot of you watching this channel are thinking about that. About half of you watching are renters, half of you are homeowners. And for the renters out there, I know a lot of you are looking to buy your first house or buy your first investment property. So how can you look at the cost of buying versus renting and help it inform you on if it's a good idea to buy? Well, we actually have a metric for that on ReVenture app called buy versus rent differential. That metric is under home prices and affordability, and it shows you the differential. And we have some crazy buy versus rent differentials here around Nashville. This zip code, 171%, meaning it's 171% more expensive to buy than to rent. Whew! I mean, if it's 171% more expensive to buy than to rent, you're going to have some issues in that market on demand because you're just going to have people electing to rent. I mean, in Nashville, there's tons of new apartment buildings offering generous discounts. Very easy to just rent and get a good deal on that, wait for the market to drop. And, you know, mortgage rates going from, say, 6.6 to 6.2%, that's not going to move the needle too much on the cost to buy. Across the U.S., the cost to buy right now is $2,800 a month, including taxes and insurance. The cost to rent is around $2,000. So we're around 40% more expensive to buy. If the mortgage rates were to drop to 6.2, let's just say, or 6.1, cost to buy would go from $2,800 to $2,700 or $2,700 to $2,600. It would be a marginal improvement. Probably not enough to bring the buyers back. I gotta say though, everyone, this street is beautiful. There are some really nice parts of Nashville. Like, this is an area, everyone, like once it corrects a bit, that will be a great place to buy. Because you're next to Vanderbilt, you're only a 5-minute drive from downtown, you're a 10-minute drive out to the suburbs to the south, and you got some beautiful houses. It's quiet, it's pristine, it's nice. So this would be the type of market where after it corrects, you would want to buy in this market. Because it's like, wow, look around you. This would obviously be a good place to own in the long run. So that's another thing you guys should think about, right? Is the short-term forecast versus the long-term value proposition, right? What's the short-term forecast? Are we in a bubble? Are the prices starting to correct? Versus, is this a place I really want to own in the long run? That's something you got to consider. And you know, this is the type of neighborhood I would definitely want to own in the long run if the prices were to come down. Again, absolutely beautiful houses here, here in 37212 in Nashville. We're also seeing this buy versus rent differential play out in Nashville's condo market. I am shocked at how much the condo prices are going down here around Nashville. Like, I'm looking at listings, condo listings. I found one the other day. This is a condo downtown. They bought it for like $650, I think, and now they're listing it for $490. So they bought it for $650, kind of peak of the pandemic. Now they're listing it for $490. That's a $160,000 loss. Whew. $160,000 loss, that's crazy. There's also another condo close by in a building I actually used to live next to where the seller is selling a 1-bedroom. They've cut it from $470 to $330. And Nashville now reminds me a lot of Florida 12 months ago in just what I'm seeing and hearing. I'm seeing a market that is definitely on the precipice of a decline. All the data is saying it. I'm seeing listings with huge price cuts. I'm going to see houses and realtors are telling me there's no offers. Exactly what was happening with Florida, but yet, when you talk to locals here, they don't totally know it yet. A lot of people still talk about this market like it's gonna go up forever, and I think what's gonna come in the next 12 months in Nashville is gonna catch a lot of people off guard who live here. I think a lot of the people here aren't ready for it. I'll do my best to inform them about what's going on, but I just think it's really interesting how I could go from Florida, see Florida a year ago, I go here, I'm seeing the same thing play out. And if you are someone who's looking to buy now or in the next 6 months, I would really encourage you guys, download the ReVenture mobile app now if you haven't already, and upgrade to see that forecast in your zip code, because that forecast in your zip code is going to help you save money on buying your house. And do not be afraid to share that forecast with the seller and the listing agent. Also share it with your buyer's agent. Use it as a negotiating tool. This is an objective forecast where we have half the country forecast to go up. We even have some zip codes still forecast to go up and markets that are declining. This is based on data. This is not based on opinion. So use that forecast to negotiate a better price and save yourself potentially tens of thousands of dollars. Our monthly plan just increased to $49 a month. The reason we increased the price was so we can support the growth of ReVenture App in the future. I now have 10 people working on ReVenture App. We have a big team now. We're expanding our team more into the future. We plan on purchasing more data in the future. So I know some of you might not be totally happy with the price going from $39 to $49, but from my perspective, it's going to support the growth of the application and actually help you guys as home buyers more into the future get a better deal. So upgrade right now to see your forecast in your zip code, and also make sure to check out that buy versus rent differential. That'll help you understand the cost of buying versus the cost of renting, and if it's a good idea to wait. Until next time, this is Nick from ReVenture signing off.